Hey everyone, and welcome back. Today we're going deep diving into the stock market
Deep.
to figure out, is it actually broken? We found this article called, Is the Stock Market Broken?
Pretty straightforward title, right?
Straight to the point.
We're going to break down the main arguments, see if we can maybe uncover some surprising facts, and hopefully you'll walk away thinking about your investments in a new way.
Sounds good.
You ever, walk in one of those super fancy buildings? All marble and chandeliers, the works.
Oh, yeah.
But then you accidentally stumble into some, back room, exposed wires and leaky pipes. That's kind of what we're doing today with the stock market.
Peeking behind the curtain. I like that.
Exactly. Now, remember back in the 90s? Investing seemed a lot simpler back then.
Right. It did seem simpler.
Company does well, stock goes up. It was all about those fundamentals.
Yeah. Like, how much money are they actually making? Are they a healthy business?
But nowadays, good luck explaining to your grandma why some company that's never made any money is suddenly worth $1 bazillion.
It's the age of meme stocks, where hype can totally overshadow actual financial performance.
Like GameStop or AMC.
Those weren't, brilliant business strategies. It was just online communities going wild and everyone afraid of missing out.
It really was.
The stock market got infected by a viral TikTok trend or something.
Yeah, and that kind of speculative frenzy can have consequences.
Oh, absolutely.
It's the market so much more volatile and unpredictable, and honestly, riskier for everybody.
It's not just the folks playing the meme stock game.
Exactly.
So, what do you think out there, dear listener? Is this just regular people taking back power? Or is it like a recipe for financial disaster?
Yeah, what do you think?
Would you feel comfortable investing based purely on hype? I mean, that's the question.
That's a good question. It really gets to the heart of what we think investing should even be about.
All right, let's shift gears for a second and talk about something that might make your head spin a little. High-frequency trading or HFT?
Ooh.
Okay, so imagine you're trying to buy a stock, right? But before you can even click buy, some supercomputer has already scanned the entire market like 1,000,000 times.
Yeah.
Snatched up all the shares at a lower price, and then sold them back to you for a profit.
All in, like a fraction of a second.
It's happening millions of times a second, every single trading day.
It's mind-boggling how fast it all happens.
These HFT firms, they're not really investing in companies, are they?
Not in the traditional sense, no.
They're playing a numbers game.
Exploiting these tiny price differences to make a quick buck.
The article compares them to caffeinated cheetahs on Wall Street.
It's a pretty accurate analogy. They're all about speed.
But no long-term vision.
Right. And so it makes you wonder, how fair is the playing field?
Exactly. Is the market really accessible and transparent when these high-speed trades are happening faster than you can blink?
Good question.
You're basically trying to catch a train that's already left the station, yeah.
Leaving you in the dust.
And speaking of train wrecks, what about those flash crashes? The market suddenly plummets and then poof, back up again like nothing happened.
Oh, yeah. Those are unnerving.
A lot of people blame those on, you guessed it, HFT algorithms.
It's like a sudden glitch in the matrix, right? And no one really knows what's going on.
Okay, let's take a deep breath and talk about something a bit more chill. Passive investing.
Ah, passive investing. It's all the rage these days.
Index funds, ETFs. Just buy a basket of stocks, sit back, and watch your money grow.
Yeah, you're basically tracking the overall market, right? It's easy, low fees.
Super appealing.
Definitely.
But here's the catch. When everyone piles into the same index funds,
Oh, here comes the twist.
it creates this weird dynamic where the biggest companies just keep getting bigger.
Just automatically, basically.
So you buy an S&P 500 index fund.
Let's say.
You're basically heavily invested in Apple, Microsoft, Amazon, the usual gang.
Makes sense.
But the more people buy into that index fund, the more those mega cap stocks are in demand.
Which pushes their prices up even more.
It's like a popularity contest where the winners just keep on winning, regardless of whether their actual business is doing any better.
You get what's called market concentration. A few powerful companies dominating the whole market.
And that brings up another issue. Price discovery.
Determining what a company is actually worth.
Are we just betting on the brand name anymore, without actually looking at the fundamentals?
It's a valid concern.
The article actually compares it to a house of cards, built on brand recognition instead of anything solid.
Not the most stable foundation.
So is this passive investing thing a smart long-term strategy? Or are we all kind of sleepwalking into a potential bubble?
Lots to think about there.
Now let's talk about something companies love to do. Give themselves a giant pat on the back.
Oh, I know what's coming.
Corporate buybacks.
When companies use their own money to buy back their own stock.
It's like they're saying, hey, everyone, look how great we are. Our stock is so valuable, we're buying it ourselves. But the article points out something interesting.
What's that?
Sometimes companies actually borrow money to fund these buybacks.
So they're taking on debt?
Just to make themselves look more profitable.
Interesting.
It's like putting lipstick on a pig, right?
Mm-hmm.
Trying to mask some deeper problems.
The article calls it out for potentially having some negative consequences, too.
Oh, yeah. Like what?
Well, it can take resources away from things like research and development.
Or employee wages.
All for the sake of making the stock price look good in the short term.
It's like they're putting on a big flashy show for investors, but neglecting the actual health of the company underneath it all.
Right. Not sustainable in the long run.
So are these buybacks a sign of true confidence in the company? Or are they just a sneaky way to manipulate the market?
And make executives look good in the process.
What do you think? Let us know. It's a good question to ask because in the end, are they really investing in long-term growth? Or just try to make a quick buck?
Exactly.
Okay, let's dive into something that might not sound super exciting at first. Regulations.
Ah, yes. The rules of the game.
I know. Not exactly a party topic, but think of it this way. Regulations are supposed to be like the referees in the stock market.
They keep everything fair, make sure no one's cheating.
But what happens if the refs aren't paying attention? Or their rule book is totally outdated?
That's not good.
The article actually compares financial regulations to a toothless watchdog.
I can see that.
It's there, but is it really doing anything?
It raises some good points about where regulations might be falling short.
Like insider trading. It's illegal, obviously.
Definitely illegal.
But catching someone doing it, almost impossible.
Like trying to catch smoke with your bare hands.
And what about all the new stuff that's popped up in the market? High-frequency trading, cryptocurrency.
Things are changing so fast.
It's like the regulators are playing checkers while the market has moved on to 3D chess.
Regulators are struggling to keep up with all the innovation.
And then there's that whole revolving door thing, right?
What's that?
People who used to work for the regulatory agencies end up getting cushy jobs on Wall Street.
Working for the companies they used to oversee?
It's like being a referee for a game and then suddenly switching jerseys and playing for one of the teams.
Definitely raises some concerns about conflicts of interest.
So does the whole regulatory system need a complete makeover?
Or is it just a matter of making some adjustments?
It's a question worth considering.
For sure. Because effective regulations are crucial for a fair and transparent market.
Okay, last but not least, let's talk about the good guy of investing.
Ooh, who's that?
ESG investing. Environmental, social, governance.
Putting your money where your values are.
It's like the warm, fuzzy sweater of investing.
It's definitely gained a lot of popularity as people become more conscious about where their money is going.
But hold on a second. Have you noticed how every company is suddenly claiming to be eco-friendly?
It's like greenwashing everywhere you look.
It's out of control.
Companies exaggerating or even totally misrepresenting their ESG efforts.
You buy a bottle of water, and suddenly they're planting a tree in the Amazon.
Makes you wonder how much of it is genuine.
Right. And the thing is, there's no standard way to measure this stuff.
Yeah, it's a bit of a Wild West out there.
It's like one company gets a gold star for using recycled paper,
while another one gets penalized for something totally minor.
No clear guidelines.
Makes it tough for investors to really compare companies.
So how can we tell if a company is truly committed to ESG or if they're just trying to make themselves look good to attract investors?
That's the big question.
Okay, so we've covered a lot of ground here.
We have meme stocks, high-frequency trading, the whole shebang.
The article doesn't give us an easy yes or no answer about whether the stock market is broken.
It's more nuanced than that.
But it definitely paints a more complex picture.
It makes you think maybe the market isn't broken in the traditional sense.
But maybe it's designed to benefit a select few.
Those who have the inside knowledge and resources.
Like a game where the rules are constantly changing and only some people know how to play.
It's a good analogy.
Makes you wonder, is the stock market really doing what it's supposed to do?
Is it really a fair game for everyone?
Or is it rigged in favor of the wealthy and well-connected?
The article argues that some of these practices we talked about,
like high-frequency trading and the lack of strong regulations,
they create this uneven playing field.
One that favors institutional investors and professional traders.
It's like going to a casino,
where the house always wins.
No matter what you do, the odds are stacked against you.
So even if the system isn't technically broken, It's got some serious issues.
Some cracks in the foundation.
What can we do to make it more equitable, more accessible for everyone?
That's the million-dollar question.
It's like we're standing at this fork in the road, right?
Yeah.
And we got to decide, what kind of stock market do we actually want? For ourselves? For the future?
A market that benefits everyone, or one that just keeps operating in the shadows, helping out a select few?
It's a big question. And what I found interesting is that the article doesn't just lay out all the problems. It actually gives us some ideas about how to fix things.
Oh, yeah. Like what?
It's like, we spent all this time exploring these dark corners and back alleys of the stock market.
We did.
But now, it's time to turn on the lights and start demanding some answers.
I like that.
And that's where you come in, dear listener.
What can we do?
It's easy to feel overwhelmed by all this, right? And think, well, I'm just one person. What can I do? But the article, it actually emphasizes how much power individual investors really have.
Yeah.
We might not be Wall Street bigwigs, but we can still use our voices.
Absolutely.
Support companies that share our values, demand more transparency.
Push for stronger regulation.
Exactly. And it's not just about what we do alone. It's about what happens when we all start doing it together.
Collective action.
What if everyone listening to this deep dive right now started asking these tough questions, demanding more from their financial advisors, holding companies accountable?
It could create a real ripple effect.
It's like shining a light on all those shady practices.
Yeah.
Enough of us do it, maybe, just maybe. We can force some real change.
We can hope.
So, after all this, I honestly don't have a simple answer to that question. Is the stock market broken?
It's complicated.
But I do know this. It's a system that needs to be watched constantly, and it needs to keep improving.
It can't just be this casino where the house always wins.
It's more than a game, you know? It's a reflection of our economy, our values.
And if we want everyone to have a fair shot at building wealth, at achieving their financial goals, then we need a stock market that works for everyone.
Not just a handful of people at the top.
Well said.
All right, as we wrap up this deep dive, we want to leave you with one final thought. Don't just accept the way things are.
Question everything.
Do your own research, challenge those assumptions, and demand better.
Because the future of the stock market, heck, maybe even the future of our whole economy,
Depends on engaged, informed people like you.
you have more power than you think.
That's a wrap on the deep dive. We hope you enjoyed this little journey into the stock market's underbelly.
It was a wild ride.
Keep those questions coming. And until next time, stay curious.